Picture a 14-year-old kid in the 1890s.
Right, just a kid.
Yeah, he's fresh out of grammar school, standing in this, bustling, cigar smoke-filled brokerage office in Boston.
That was chaotic.
Oh, completely. He's a bored boy. His entire job is to just listen to the ticker tape machine clicking away and write the changing stock prices on a massive chalkboard.
Just surrounded by screaming traders all day.
Exactly. But the thing is, he isn't looking at company valuations. He doesn't know the first thing about earnings reports or, corporate leadership.
Right.
He is literally just watching the numbers change day in and day out, and he starts realizing for the very first time that human behavior leaves a mathematical fingerprint.
It's just a striking image to start with, especially when you realize, that kid staring at the chalkboard would grow up to be one of the most feared and respected financial minds in Wall Street history.
Welcome to today's Deep Dive. Today, we're exploring the life and the strategies found in the legendary 1923 book Reminiscences of a Stock Operator by Edwin Lefèvre.
Which is widely understood to be the thinly veiled biography of Jesse Livermore.
Right. And our mission today is to trace the evolution of this incredible trader, following him from, a teenage gambler in these shady bucket shops, all the way to a macro thinker who literally stood toe-to-toe with J.P. Morgan.
And we're doing this because, the mechanics of how we buy and sell might look completely different today than they did in 1890. But the underlying psychology, it's identical.
Human nature hasn't changed.
Exactly. We want to extract those timeless rules of how markets, and more importantly, how people actually behave.
So let's unpack how a 14-year-old actually starts trading without any money or formal education.
Yeah, how does that happen?
Well, he's standing at this chalkboard, and he begins keeping what he calls a dope sheet.
A dope sheet.
Yeah. He was naturally gifted at mental math, so after watching those numbers shift on the board 5 hours a day, he started making, hypothetical bets in a little notebook.
Oh, I see.
He noticed that stock prices had habits. He'd see a pattern, write down what he thought the stock would do on Tuesday, and then check the tape on Wednesday to, verify his hypothesis.
So he was essentially building a mental database of price action.
Right.
He was training his brain to recognize momentum before he ever actually risked a dime.
And his hypothetical system works so well that a coworker eventually tips him off that a stock called Burlington is going to go up.
Okay.
He checks his notebook, confirms the stock is acting the way it normally does before a major rise, and he pulls his money for his very first real trade.
And how did he do?
He nets a profit of $3.12.
Hey, not bad for the 1890s.
Right. But he doesn't do this at a legitimate Wall Street brokerage. He goes to what was called a bucket shop.
Ah, the bucket shops. Those are the crucial training ground for everything he does later.
Yeah.
To understand them, you really have to understand that in a bucket shop, you weren't actually buying or selling real stock on the New York Stock Exchange.
You were just playing the house.
Exactly. You were effectively placing a side bet with the house, like a casino, on what the ticker tape was going to print next.
Wait, for those of us who, only know digital charts on our phones, let's define the ticker tape real quick.
Oh, good point. So the ticker tape was a physical telegraph machine.
Okay.
It sat under a glass dome in offices across the country, constantly receiving electrical signals from the New York Stock Exchange. And it would print out stock symbols and prices on this long, continuous ribbon of paper.
So the bucket shop is essentially a sports book taking bets on that paper ribbon.
Right.
You could put down a tiny margin, say just a $1 deposit, to bet on a stock's movement. But the catch is, the moment the stock moved against you by that $1 on the tape, your bet was automatically wiped out.
The house just kept your dollar.
Yeah.
And just like a casino, the house relies on the odds being stacked against you.
Right. But his pattern recognition was so good, he started beating the house consistently.
He became known locally as the boy plunger.
Which is an amazing nickname. And he got so profitable that the smaller bucket shops actually started banning him from coming inside.
They just wouldn't take his action anymore.
Exactly. Which forces him to resort to trading at the biggest, richest bucket shop in New England, the Cosmopolitan.
Okay.
And they decide they are going to take him out. He is heavily short on sugar stock, meaning, he placed a bet that the price of sugar would go down.
Right.
He's short 3,500 shares, and the market is acting weak, which is great for his position. But suddenly, as he's watching the tape, he just feels that something is wrong.
A hunch.
Yeah, the stock starts hesitating. The engine, as he puts it, wasn't hitting right.
He senses a trap, based purely on the rhythm of the price action.
Yes. So he rushes to the counter and closes his entire position,
Right.
cashing out his profits right at the last quoted price of 103.
And his timing is terrifyingly perfect.
Unbelievable, right? Because what happens literally seconds later is this masterclass in market manipulation.
Oh.
The Cosmopolitan had a lot of customers, including our guy, who were shorting sugar. They wanted to wipe all those people out. So the Cosmopolitan maliciously orchestrated a wash trade on the actual New York Stock Exchange.
Let's break down how brazen that is.
Please do.
The bucket shop owners in Boston secretly wired their brokers in New York and told them to artificially buy up real shares of sugar stock all at once.
Wow.
They intentionally drove the real price of sugar up to 108 for just a brief moment.
Just long enough for the telegraph machine to print 108 on the paper ribbon in Boston.
Yes. The real price fell right back down minutes later, but that temporary printed spike to 108 instantly wiped out the tiny margins of all the bucket shop customers who had bet the price would go down.
Except our protagonist, because he sensed the artificial setup and closed out moments before.
He beat them at their own game.
He did. Now, think about this bucket shop system for a second. It's like playing a modern video game on easy mode or trading in a fake paper trading simulator.
That's a great way to put it.
In the bucket shop, your trade executes instantly at the exact price you see on the screen because you aren't actually transacting in the real market.
Your trade has absolutely zero impact on the actual supply and demand of the stock.
Okay.
It rewarded pure, isolated pattern recognition, but it created a massive illusion. He thought he was learning how to beat the market, but he was actually just learning how to beat the artificial mechanics of the shop.
So when the Cosmopolitan finally bans him too, he is forced into this massive reality check.
Oh, yeah.
He has to take his $2,500 stake to New York. He walks into a legitimate stock exchange brokerage where he's trading real shares. And his perfectly tuned, highly profitable system just immediately breaks down.
It entirely shatters.
Yeah.
And the painful climax of this happens during the May 9th panic of 1901.
Okay.
This is the famous Northern Pacific corner.
Wait, let's pause and clarify that. What exactly is a corner?
A corner happens when wealthy investors or syndicates quietly buy up nearly all the available shares of a specific company.
Like monopolizing the stock.
Exactly. In this case, two massive financial titans were fighting for control of the Northern Pacific Railway. They bought so much stock that there was almost none left available to trade.
Oh, wow.
So anyone who had shorted the stock, meaning they borrowed shares to sell them, hoping to buy them back cheaper later, was suddenly trapped.
Because they had to return them.
Right. They were forced to buy shares to cover their loans, but the tycoons held all the shares and could demand any price they wanted.
It creates an absolute bloodbath.
Complete panic.
Our young trader is watching the tape, and he perfectly anticipates that this corner is going to cause a massive, broader market crash as everyone liquidates their other stocks to cover their Northern Pacific losses.
He sees the dominoes falling.
He is dead right about the direction. He sells short, expecting the broader market prices to plummet.
Yet he manages to lose his entire $50,000 stake despite predicting the crash perfectly.
Wait, how is that even possible? If he knew the crash was coming, how does he go bankrupt?
Because the reality of market mechanics crushed him. Remember the physical ticker tape machine?
Yeah, the telegraph.
During a panic, the volume of trading is so frantic that the telegraph system simply couldn't keep up.
Yeah.
The tape he was reading in the broker's office was lagging hours behind the actual trading floor.
Oh, man, so he's looking at a ghost.
He is. When he put in a market order to sell based on the price he saw on the tape, let's say it's at 100 hertz, by the time his physical order ticket reached the floor trader, the real price had already plummeted to 80.
Wow.
He was unknowingly selling at the absolute bottom. And when he panicked and tried to buy back in to cover his position, he ended up paying a massive premium on the rebound.
The delay just completely destroyed him.
It wiped him out.
Wait, I'm stuck on something here. I think anyone listening to this would ask the same thing.
What's that?
If he knows the machine is 3 hours behind the real world, why on earth is he throwing blind market orders into the void? Why not just use a limit order and say, hey, only sell my stock if you can get exactly $100 for it?
It's the logical question. But his answer gets to the very core of his philosophy on speculation.
Okay.
He firmly believed that if you use a limit order, you are trying to dictate terms to the market. You are haggling.
Haggling.
Yeah, and by haggling over a specific number, you risk missing the movement entirely.
So you're trying to force the market to meet your demands rather than flowing with where the market is actually going.
Yes. The ultimate lesson he took from that devastating loss wasn't to start using limit orders.
What was it?
It was a much more profound realization. Reading the tape for microscopic minute-by-minute fluctuations isn't enough anymore.
Right.
If your own orders are now large enough to move the real market, and the market mechanics themselves are chaotic, you cannot survive by scalping fractions of a point. You have to learn to anticipate what is going to happen in a big way.
He needs a wider lens. He has to stop looking at the daily noise.
Exactly.
Which leads us to one of my favorite figures in these sources. Mr. Partridge, who was universally known in the brokerage office as Old Turkey.
Old Turkey is just the embodiment of patience. He was an older, quiet man who never bragged, never gave unsolicited advice, and always just sat back and listened to the chaotic chatter of the younger traders buzzing around him.
And the defining story for Old Turkey revolves around Climax Motors stock.
Oh, this is a classic.
Yeah. Another trader, Elmer Harwood, rushes up to Old Turkey in a frenzy. Elmer is thrilled because he just sold his Climax Motors shares and locked in a 7-point profit.
I'm feeling pretty smart.
Very smart. He tells Old Turkey the market is going to dip, so you should sell yours right now and we'll just buy it back cheaper after the reaction.
And Old Turkey just smiles politely and refuses.
And Elmer is furious because Elmer is the guy who gave Old Turkey the tip to buy the stock in the first place.
Right.
He demands to know why Old Turkey won't sell to secure his guaranteed profit. And Old Turkey simply replies, if I sold that stock now, I'd lose my position. It's a bull market, you know?
I'd lose my position.
That is such a powerful concept.
It really is.
If you're listening to this right now, think about how often you might check a modern portfolio app. You see a stock is up $20, and you feel that overwhelming urge to sell it just to lock in the dopamine hit of a win.
You want to take the money and run.
Right. But it's like trying to jump off a moving freight train just to pick up a dollar bill off the tracks. Sure, you might grab the dollar, but you risk watching that train accelerate away into the distance without you.
You've lost your seat on the main move.
Exactly.
It highlights an immense psychological friction. Being right about the general direction of a market is actually quite common. People guess right all the time.
Sure.
But being right and sitting tight, having the discipline to do absolutely nothing while your profit fluctuates day to day, that is incredibly rare.
It's excruciating.
It is. Old Turkey understood that disregarding the main movement, the big swing, just to try and catch minor dips and peaks is fatal. The big money in investing isn't made in the buying or the selling. It is made in the waiting.
But waiting requires an immense amount of inner conviction. If you don't truly believe in your own thesis, every little dip is going to terrify you into selling.
Absolutely.
And that brings us to the tension between relying on your own intuition versus listening to outside noise. Let's look at his vacation in Atlantic City in 1906.
Right. So he's taking a break. He has no positions in the market, and he's just looking at the, quote, board in a local brokerage out of pure habit.
As you do.
Naturally. The broader market is incredibly strong. Everything is going up. But suddenly, as he's watching the price action of Union Pacific stock, he gets a blind, inexplicable urge to sell it short.
His friend, who is standing right there, thinks he has lost his mind.
Totally crazy.
But he walks up to the counter and shorts 1,000 shares. Then he goes back and shorts another 1,000. He eventually dumps 10,000 shares against the frantic, logical warnings of his friend.
Wow.
He literally tells his friend he has no concrete reason, just a feeling that the stock is heavy. And the very next day, the San Francisco earthquake hits. The city burns, the market collapses, and he makes $250,000.
Just an incredible turn of events.
Now, I have to be the skeptic here.
Go for it.
When you read that account, it sounds like he is claiming to have psychic powers. Did he somehow magically sense an earthquake? Because that contradicts his entire mathematical tape-reading foundation.
I know it sounds mystical on the surface, but when you really break it down, it wasn't magic at all.
Okay, then what was it?
It was the subconscious synthesis of thousands of hours of screen time. His conscious, logical mind hadn't formulated the exact bearish argument yet, but his highly trained eye noticed subtle, microscopic weaknesses in the way Union Pacific was absorbing buy orders.
Interesting.
The stock wasn't behaving the way a strong stock should behave in a bull market. The hunch was simply highly compressed experience sounding an alarm.
That makes a lot of sense. It's like a seasoned mechanic hearing a subtle rattle in an engine and knowing it's going to fail, even if they haven't opened the hood yet.
Exactly. But the deeper takeaway from this period isn't about subconscious hunches. It becomes clear when we contrast the earthquake story with what happened later that same summer in Saratoga.
Ah, yes, the Saratoga blunder. This is the exact opposite scenario.
Very different, yeah.
He is analyzing the tape perfectly.
Yeah.
He sees clear mathematical evidence that Union Pacific is being quietly accumulated by big institutional players.
She's got the read.
He trusts his read, he starts buying it, and the stock behaves exactly the way he expects. He's building a massive, profitable position based entirely on his own independent reading of the market.
But then, his trusted, well-meaning broker, Ed Harding, calls him in a panic.
Uh-oh.
Harding is a Wall Street insider, and he insists that the executives at Union Pacific are actually dumping the stock.
Right.
He tells our trader that he is being played for a sucker by the big syndicates.
Right.
Harding begs him to sell before the floor falls out.
And despite all his own research, he listens. He abandons his own
A
conviction.
huge mistake.
He sells all his long positions and actually flips to betting against the stock. And the very next day, Union Pacific unexpectedly declares a massive, unprecedented 10% dividend.
Ouch.
The stock rockets upward. Listening to that insider tip costs him $30,000 before he realizes his mistake and scrambles to reverse his position.
This is perhaps the most pivotal moment in his evolution. The lesson he takes away isn't just that the broker's tip was factually wrong.
Right.
It's a realization about independence. Relying on tips, even from brilliant, well-meaning insiders, fundamentally forces you to play someone else's game.
Because you don't know the whole story.
Think about it. If you buy a stock simply because someone gave you a tip, you are entirely dependent on them to tell you when to sell it. You have zero internal conviction.
You're flying blind.
Exactly. If you want to have the courage to be old turkey and sit tight through the volatility, you must follow your own line of reasoning.
So he has learned to look for the big swing instead of the daily noise, and he has learned that he has to fiercely protect his own independent conviction.
Where does this evolution finally climax?
It climaxes in the brutal panic of 1907. This is the moment he truly masters the macroeconomic picture.
Okay.
He stops just looking at isolated stock quotes and starts looking at the underlying fundamental conditions of the American economy. He starts noticing that major prestigious railroads like Great Northern and St. Paul are issuing new stock to the public on installment plans.
Wait, why is an installment plan a red flag?
Because massive corporations require immense amounts of capital to lay track and build infrastructure. Normally, they just walk into a major Wall Street bank, secure a multi-million-dollar loan up front, and get to work.
Right.
If these titans of industry are suddenly reduced to begging retail investors for $10 a month on an installment plan, it means the Wall Street bank vaults are physically empty. The credit has completely dried up.
Oh, wow. He realizes the entire system is running on fumes.
Exactly.
He sees a massive credit crunch coming, so he aggressively shorts the entire market. He bets against everything. And then comes October 24th, 1907.
A dark day.
The money supply just evaporates. If you read the historical accounts of that day, it sounds apocalyptic. On the floor of the New York Stock Exchange, there was a physical location called the Money Post, where brokers would normally go to borrow cash to settle their daily trades.
But on this day, there was absolutely zero liquidity. Nobody had a single dollar to lend.
Picture a mouse trapped in a glass bell jar while a vacuum pump slowly sucks all the oxygen out of the room. That was the crowd of desperate brokers at the Money Post.
It's a terrifying image.
Just gasping, panicking, knowing that if they couldn't find cash in the next hour, half the brokerage houses on Wall Street would go bankrupt.
It was the brink of total systemic collapse. It got so bad that the president of the exchange actually crosses the street to the offices of J.P. Morgan, pleading for salvation. Yeah, and Morgan steps in, unilaterally forces the banks to illegally dip into their required cash reserves, and physically sends $10 million to the floor to keep the market breathing.
And our protagonist, he makes over $1 million that single day from his short positions.
Incredible.
But what is truly amazing is his pivot. Out of a sense of patriotism and purely logical long-term thinking, the moment the market hits absolute rock bottom and the panic is at its worst, he stops shorting.
Right.
He pivots and buys 100,000 shares of various companies to help stabilize the panic.
His greatest triumph that day wasn't making $1 million.
What was it?
It was the realization of what he had finally become. He was no longer a teenager gambling against a Boston bucket shop, fighting the tape for fractions of a point.
Yeah.
He had matured into a true speculator, operating in partnership with the underlying fundamental conditions of the global economy.
He had leveled up completely. But here's the thing, even with that grand macro view of the economy, he still needed a tactical system for actually entering his trades without getting crushed.
Yes, the execution is still key.
And this brings us to his mature method of finding what he calls the line of least resistance.
A brilliant way to understand the line of least resistance is to the story of Deacon S.V. White.
Okay.
Deacon White gets an absolutely certain tip that a syndicate of insiders is buying massive amounts of sugar stock, planning to drive the price up.
Right.
Now, most people would hear that, panic, and blindly buy as much as they could. But Deacon White wants to test the market's actual capacity first. So instead of buying, he walks onto the floor and immediately sells 20,000 shares of sugar.
Hold on. He thinks the stock is going to go up, so he dumps a massive amount of shares onto the market. That sounds like financial suicide.
It seems backwards, I know, but it's a highly calculated test.
Okay.
If the tip is fake and nobody is actually buying, dumping 20,000 shares will crash the price instantly. But when the market easily absorbs his massive sell order and the price barely drops at all, it proves to him that the tip is true.
Oh, I see.
There is indeed a hidden whale underneath the surface with massive buying power, eating up every share available.
The resistance to going down is so strong, it proves the line of least resistance is up.
Yes. Only after he proves the market's underlying strength does he cover his short position and aggressively buy 30,000 shares. He tested the floor before he jumped.
And our protagonist adopts a very similar, highly disciplined approach to accumulating his own positions.
He does.
He establishes a rule: you should never buy your entire position all at once. You buy 1/5 of your planned total. You wait to see if that first trade actually shows a profit. You only add to your position if you are currently winning.
Which brings us to the psychological crux of this entire deep dive.
It does, because this rule sounds utterly backwards to normal human nature.
It really does.
Think about how we shop in the real world. We
Yeah.
love a bargain. If you buy a stock at $100 and it drops to 90, human nature screams, great, it's on sale. Average down, buy more at 90 so your overall average cost is lower. He is saying you should do the exact opposite. He wants to buy the next batch at 105 and the next at 110. He wants to average up.
And that is exactly why most people fail in the markets. A successful speculator must actively fight their deepest, most ingrained human instincts.
Fight yourself.
Think about the emotional mechanics of a trade. When a trade goes against you and you start losing money, human nature instinctively hopes it will recover.
Yeah, you don't want to admit defeat.
Exactly. That hope causes you to hold on, to average down, and what should have been a small, manageable loss turns into a devastating financial disaster.
And the reverse is true for profits.
Precisely. When a trade goes your way and you see a profit on your screen, human nature instinctively fears losing that profit. You get anxious.
You want to cash out.
That fear causes you to sell way too soon, just like Elmer Harwood jumping off the moving train for his little 7-point gain.
Yeah.
Our natural hardware is quite literally wired to fail in the financial markets.
So the successful operator has to completely reverse their emotional impulses.
They do.
You must fear that a small loss will grow into a massive one and cut it ruthlessly. And you must hope that a small profit will grow into a life-changing one and have the old turkey courage to sit tight and let it ride.
Fight your instincts. Fear your losses and hope for your profits.
Yeah.
It is a total paradigm shift.
So let's step back and look at the incredible arc of this journey.
It's quite a ride.
We started with a 14-year-old kid covered in chalk dust, betting on microscopic ticks of a telegraph machine in smoky bucket shops. We watched him lose everything when he tried to force those artificial video game tactics onto the brutal reality of the New York Stock Exchange.
Right.
We saw him learn the painful cost of listening to insider tips and the immense quiet value of being old turkey and sitting tight for the main movement.
Yeah.
And finally, we saw him evolve into a macro thinker, testing the liquidity of the market, reading the fundamental health of the economy, and stabilizing Wall Street during one of its darkest panics.
It's amazing.
The ultimate lesson here is that nobody, no matter how smart or how fast, can beat the market itself. You can only align yourself with the fundamental conditions.
It is a remarkable evolution from seeing prices as isolated floating numbers to seeing the physical mechanics of the exchange floor to finally seeing the vast economic reality that drives it all.
It really makes you wonder about the modern financial world you and I live in today.
Oh, absolutely.
We have zero-commission retail trading apps on our phones with confetti animations. We have algorithmic trading, instantaneous financial updates on social media, and a relentless 24/7 news cycle.
It raises a very provocative thought. Have we essentially just rebuilt the 1890s bucket shops, but this time on our smartphones?
Are we being subtly conditioned by these gamified apps to gamble on the daily noise? Are we trading on easy mode without truly understanding the underlying reality of the assets we are buying?
That's the real question.
And if so, how can we train ourselves to step back? How do you ignore the endless, deafening stream of notifications and tips and find the courage to become your own version of old turkey and simply sit tight?
Yeah.
It is definitely something to mull over the next time you look at a chart. Because whether you were reading a paper tape in 1890 or a digital screen today, beneath all the technology, human behavior still leaves the exact same mathematical fingerprint.